The Intelligent Investor, the definitive book on value investing, by Benjamin Graham. This is a book summary. Champagne flows, ticker tape flies, men in double-breasted suits shout orders across the exchange floor. The energy is electric. The skyline glistens with prosperity. The year is 1929. Wall Street is high on its own success. The stock market has become the nation's playground. Everyone from seasoned bankers to shoeshine boys is placing bets like there's no tomorrow. Tips are flying. Fortunes are growing. The American dream is on fire. And in the minds of millions, the party will never end. But then, the music stops. October 29th, 1929, Black Tuesday. In a matter of days, $30 billion vanishes from the stock market. Families lose everything. Lifetimes of savings, gone. It's not just a crash. It's a collapse of confidence. The illusion that stocks only go up is shattered forever. But out of the dust, out of the chaos, steps a quiet thinker. Not a Wall Street tycoon, not a gambler, a scholar, a man who dared to ask, what if investing wasn't about chasing riches, but avoiding ruin? His name? Benjamin Graham. His legacy? Unshakable principles in a world driven by panic. His message? You're not playing a game, you're building a fortress. This is not a book about getting rich quick. This is a book about not getting poor slowly. Section 1. The origin story. To understand the intelligent investor, you have to understand the man behind it. Benjamin Graham wasn't born wealthy. He tasted abundance and then watched it vanish. After his father died, his family fell from comfort into hardship. They went from Fifth Avenue elegance to struggling to make ends meet. He learned early what it meant to feel financial fear. And he decided no one should go through life unprepared. No one should lose everything because they weren't taught how to protect something. He turned his pain into purpose. He became a professor and soon the most influential financial mind of the 20th century. His students called him a genius. One student in particular would call him life-changing. A young man from Omaha named Warren Buffett. Stocks are not lottery tickets, they're ownership in real businesses. Graham taught that when you buy a stock, you're buying a piece of a company. Not a gamble, a business. The market is emotional, not rational. The market overreacts. It swings from euphoria to despair. Your job? Stay sane while the world goes crazy. The biggest risk in investing is not the market, it's you. Greed, fear, impulse. These are the real threats to your portfolio. And they all live in the mirror. And the golden rule? Always invest with a margin of safety. Because even the best analysis can be wrong. The future is unpredictable. Build your fortress accordingly. Graham didn't just write a book. He created a philosophy, a blueprint for financial survival in a world that's anything but stable. The intelligent investor isn't flashy. It's not sexy. But it's timeless. It's the voice of reason in a screaming room. Here's the question Benjamin Graham asks you right from the very first chapter. One question that defines everything you do with your money. Are you an investor or a speculator? The speculator is fueled by adrenaline. He buys because a stock is going up. He sells because it's going down. He listens to tips, follows hype, watches charts, not businesses. Speculation feels like action. It feels smart. It feels bold. But more often than not, it's just noise dressed as knowledge. The investor is different. The investor doesn't ask, what's hot? They ask, what's it worth? They seek one thing, value. Not just price, but value. Because, to the intelligent investor, a stock isn't just a blip on a screen. It's a share of a business. A piece of a real-world machine that makes things, sells things, and earns money. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. If what you're doing doesn't pass those two criteria, safety of principal and an adequate return, you're not investing, you're gambling, just dressed up in a tie. And the market doesn't care if you call yourself a genius. If you're making decisions on instinct or emotion, you're playing a dangerous game with your future. In The Intelligent Investor, Graham doesn't just tell you what investing is. He tells you what kind of investor you might be. Because not everyone plays the same game. 1. The defensive investor. He seeks peace of mind. His goal isn't to win big. It's to not lose big. He values simplicity. He avoids risk and resists emotion. He leans on long-term strategies like dollar cost averaging. He diversifies. He automates. He trusts the slow burn of time. The defensive investor is not lazy. He's wise. He knows the game is stacked with noise and emotion. And he chooses a path that limits mistakes. 2. The enterprising investor. This investor wants more. But he earns it the hard way. He rolls up his sleeves. He reads financials. He finds opportunities the market has overlooked. He doesn't chase. He calculates. He's not trying to beat the market every day. He's trying to buy $1 of value for 70 cents. Now Graham doesn't say one of these is better than the other. That's not the point. He says, know thyself. Because pretending to be a warrior when you're wired for peace is a shortcut to burnout and regret. The investor's chief problem, and even his worst enemy, is likely to be himself. So before you pick a stock, before you open that app, before you listen to that talking head on TV, ask yourself the real question: who are you in this market? Are you investing with intention, or are you just reacting with emotion? Mr. Market, the most famous metaphor in finance. Let me introduce you to someone you think you know. He shows up every day. He's dramatic. He's emotional. He has no chill whatsoever. Meet Mr. Market. Doesn't care about facts. He doesn't read balance sheets. One day, he's euphoric, bouncing off the walls, offering you double what your stocks are worth. The next, he's weeping in the corner, begging you to take pennies on the dollar. He's not consistent. He's not rational. But here's the trick. He's not your guide. He's your opportunity. Graham's metaphor, introduced in Chapter 8 of The Intelligent Investor, isn't just clever, it's crucial. He warns us, don't take Mr. Market's offer just because he's loud today. Think like a business owner, not like a speculator at an auction. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Benjamin Graham. Here's the difference. Most people let Mr. Market tell them what something is worth. But the intelligent investor? He already knows the value and uses Mr. Market's mood swings to his advantage. He buys when Mr. Market is depressed. He sells when Mr. Market is manic. And most of the time, he just ignores him completely. Because sometimes the best move in investing is to close the door. Let Mr. Market knock. The margin of safety. Every great engineer knows you don't build for what's expected. You build for what might go wrong. A bridge designed to carry 10,000 pounds isn't built to handle 10,001. It's built to carry 15,000, maybe more. That invisible cushion? That's called the margin of safety, and in finance, it's just as vital. Benjamin Graham's margin of safety principle from Chapter 20, the final and most essential lesson in The Intelligent Investor, is brutally simple. Never pay full price for uncertainty. Always build a cushion. Assume you might be wrong. The intelligent investor doesn't try to predict the future. He prepares for it. Because even the best analysis can be shattered by bad luck, bad management, or just plain bad timing. If you wouldn't buy this used car without checking under the hood, why on earth would you buy a business with your life savings without checking the financials? Graham teaches us it's not just about finding good investments. It's about not overpaying for them. It's about saying no, especially when everyone else is saying yes. The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. Because you don't get rewarded in investing for being optimistic. You get rewarded for being prepared. Benjamin Graham said it loud and clear. Not just once, but again and again throughout The Intelligent Investor. Your greatest threat is not inflation, not interest rates, not a recession, not even the Federal Reserve. Your biggest enemy is you. Because when the market drops 20%, your instincts scream. Sell everything. When stocks are soaring, your gut says, buy more, you're missing out, but instincts in the market are often the perfect opposite of intelligence. You panic when prices drop, you get greedy when they rise, but the intelligent investor, they do the opposite. They buy when it's lonely, and they sell when it's loud. Be fearful when others are greedy, and greedy when others are fearful. Warren Buffett, Graham's student. That's not just clever advice, it's battle-tested wisdom. Because markets are made of people, and people are emotional. They follow the crowd, they follow momentum. But as Graham reminds us, the market is not a weighing machine. It's a voting machine in the short term. And most voters, they're emotional wrecks. The investor's chief problem, and even his worst enemy, is likely to be himself. If you can master your emotions, your fear, your greed, your ego, you've already outperformed half the market. Because the real test of intelligence in investing isn't IQ. It's emotional resilience. Graham understood something most investors never want to admit. Not everyone is built to pick stocks. Not everyone should. His solution? Simplicity. Automation. A strategy that works quietly while you live your life. Dollar cost averaging. Invest the same amount at regular intervals, no matter what the market is doing. You buy more when stocks are cheap and less when they're expensive. Over time, it evens out. And most importantly, you stay invested. You stay disciplined. Index investing. Instead of chasing the next hot stock, own them all. With a low-cost index fund, you capture the entire market's growth. No guesswork, no gambling. Just steady, consistent wealth building. It's not sexy, it's not thrilling. You won't brag about it at parties. But it works. Graham reminds us, true investing isn't about excitement, it's about behavior. And sometimes the most boring plan is the most brilliant. Graham didn't just give us philosophy. He gave us proof. He walked us through case after case where appearances misled and where investors paid the price. The lesson? Don't invest because of headlines. Don't invest because it's trending. Don't invest because someone shouted, "Buy now," on social media. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. Benjamin Graham. The company that everyone believes in today can disappear tomorrow. Graham's rule? Look at the numbers. Look at the balance sheet. Because hype fades, but math endures. This book was first published in 1949, in a world of post-war recovery, ration coupons and rotary phones. But somehow, every single page still applies. In a world of TikTok trading tips and YouTube get-rich-quick schemes, The Intelligent Investor is the antidote. It's not just a book about investing, it's a manual on how to think clearly when the world has lost its mind. Be patient. Demand value. Control your emotions. Respect risk. Think long-term. And above all, protect your margin of safety. Warren Buffett read this book at 19. He called it by far the best book on investing ever written. He went on to build one of the greatest fortunes in history. Not by speculation, but by following Graham's principles. Maybe it's time you read it too.